Good afternoon. Thank you for joining us for today's discussion on charitable planning and tax strategies for 2022, hosted by PBMares Wealth Management and presented alongside our special guest, Fidelity Charitable. My name is Dan Yu, and I am a senior wealth advisor here at PBMares Wealth Management. Before we get started, there are a few housekeeping items to cover. Today's webcast is being recorded, and you will receive a link to the recording and slides in our follow-up email to you after the broadcast. If you have any questions during today's presentation, you may enter them in the questions box on your screen. We will try to answer as many questions as we can today, but if we don't get to your question, one of our team members will follow up with you after the webcast. If you have any technical difficulties during today's live portion, remember that you can refer to the recording or reach out to any of our team members with a specific question that you might have. Today's guest speaker is Jim Carpenter, Vice President and Charitable Planning Consultant at Fidelity Charitable. You've probably heard of Fidelity because it's a financial institution that's been around for over 75 years. Fidelity Charitable is an independent public charity that has helped donors support more than 300,000 nonprofit organizations with over $61 billion in grants. In fact, last year alone, Fidelity Charitable distributed over $10 billion and listed as the nation's top grant maker. The PBMares Wealth Management team has partnered with Jim and Fidelity Charitable on many occasions to help clients make a great charitable impact alongside an excellent tax benefit that fits within a comprehensive financial plan. And with that, Jim, thanks so much for joining us today.
Well, thank you, Dan. Thanks very much for having me, and thanks for that generous introduction. And I look forward to working through today's presentation. Let's see if we can get my slide to advance. Here we go. Why am I not? That was the first technical difficulty. There we go. Okay. So we're going to talk about charitable planning for 2022, and in partnership with our good friends at PBMares Wealth Management. I always have to start with this particular slide as a reminder. As Dan noted, Fidelity Investments has been around for a good long time, and Fidelity had operations in all sorts of parts of the financial services business. But we are Fidelity Charitable. We're an independent 501c3 public charity started in 1991. And our mission since the beginning has been to grow the great American tradition of philanthropy by making charitable giving simple and accessible and effective. It's been quite successful for us. The charity has grown over the years. As Dan mentioned, last year we did grant out roughly $10.5 billion. So over the years, it's been about $61 billion of total grants out to hundreds of thousands of separate charities. All of this does add up to make us, we are now the largest grant-making charity in the United States. And as we'll see on my slide here, thinking about philanthropy in general, Americans are fantastically generous as a group. You can see on my chart here the year-over-year nominal and real number for charitable giving. We get this off of tax returns, both individual tax returns and then the filings from charities, and we get it all crunched together. So we don't have the 2021 numbers yet, but in 2020, Americans gave about $471 billion to well over 1 million different charities in the United States. That's a huge number. It's about 2.3% of GDP. It's sort of a monstrous number. From a scale standpoint, as a percentage of GDP, the next country on the list are the Canadians at about 0.75% of GDP, so roughly 1/3 of the charitable giving that Americans do. And I always get asked if that has to do with taxes. And no, because the next 2 or 3 countries on the list all have a much higher tax environment than the United States. It really is because Americans are fantastically generous. And we'll talk about some ways to really ramp that up over the course of this presentation. The other part of this slide is quite interesting. We get a lot of press. We certainly read in the press and get on TV, public radio, all of the names of the big foundations, the Ford Foundation, the Gates Foundation, the Alfred P. Sloan Foundation, the Lilly Foundation, all of these giant corporate givers and foundation givers. But the answer is this huge number of charitable giving, almost 70% of it is individuals writing checks or swiping their credit card on the website for individual charities that do work that's important to them, whether it's their local food bank or the pet rescue or their church or their alma mater. But the vast majority of this charitable giving is individuals making gifts to charities that are important. And if you add in the slot that's bequests, which is of course also individuals making gifts, although they're now deceased, it's over 80% of the charitable giving is individuals, not the big names that we see in the paper. Let's just a quick review from a tax standpoint. I know many of you are tax professionals or have great tax advisors, but just a quick review for charitable tax incentives from an income tax standpoint. As you know, you make a gift to charity, it's going to be a tax deduction, and it goes like this. If you make a cash gift, cash and cash equivalents, like write a check or use your credit card to a public charity or a donor advised fund sponsor like Fidelity Charitable or some of our other peers, you can take a tax deduction for the amount of that gift all the way up to 60% of your adjusted gross income. So giving cash to charities is the tax code is a great incentive for that. If you make a cash gift, on the other hand, to a private charity, maybe you have a family foundation or you know people have a family foundation. If you make a cash gift to a private charity, there's a lower limit to how much you can take as a tax deduction. It's capped at 30% of adjusted gross income. That's for giving cash. If you gift long-term appreciated property, which here at Fidelity Charitable, about more than 70% of the gifts into Fidelity Charitable are long-term appreciated property. Think about stocks and bonds with embedded capital gains. Stocks that you've owned for more than a year that went up, so now you have embedded capital gains. So though you can make gifts of appreciated property, and those are capped at 30% of AGI, gifts to public charities like us, or a little bit lower, capped at 20% as gifts to a private charity like a private family foundation. So that's what you'll see. That's where the caps are in your Schedule A. If you happen to be terrifically generous, or you make your gift in the middle of the year and it turns out you miscalculated what your AGI was going to be for that year, don't worry, because any charitable gifts that are capped because of these AGI limits, there's a 5-year carry forward. So any gifts that are disallowed this year because of the upper limits, they're going to hit first dollar tax deduction next year as a carryover onto Schedule A. So that's the income tax stuff. For capital gains taxes, this is going to be around the gifts of appreciated property, and short-term gifting property with short-term capital gains. It really doesn't work. The gain is still going to be taxed to the donor at ordinary rates. So they should just liquidate and make a cash gift generally. But long-term appreciated property owned for more than a year, as you know, their capital gains tax rates are lower than ordinary income generally, 15 to 20% for long-term capital gains, depending on the balance of your adjusted gross income, with the high earners with a little bonus of 3.8 against Medicare to help fund Medicare. So the long-term gains are taxed there, but long-term gains that are gifted to us, if you gift appreciated property, 2 things are at work. One is, as we saw in the previous slide, it's tax deductible. The value of the gift is tax deductible. And the second is that the charity is going to pay the tax on the embedded gains in the gift at the charity's rate, which is 0. So the long-term capital gain that's embedded in a charitable gift, there's no taxes paid on that for publicly traded securities. So that's the source of a considerable amount of the gifting into sort of large charities, and particularly, of course, here at Fidelity, because we have our investment associates. From an estate tax standpoint, the charitable incentives are quite straightforward. If you make a gift to charity in advance, or if you make a gift to charity as part of your estate plan or estate settlement, that charitable gift is going to come out of the estate, and the estate has an unlimited deduction for charitable gifts. So, and we have a lot of families that are maybe, if they have a taxable estate, they might make gifts to the kids up to the estate tax exemption, and then the balance goes to charity. So in fact, there's no taxes paid. But charitable tax incentives are really straightforward from an estate planning standpoint. You've given it away. It's no longer taxable in the estate, and you can give as much as you want. There are some great financial planning techniques and estate planning techniques around this charitable tax incentive from a legacy standpoint. So let's talk about charitable planning in the sort of broader financial planning and estate planning arena. The industry term we use is giving vehicles, but it's the kinds of accounts that people create to fund or facilitate their charitable giving into the future. And we break them into 2 sections: giving while living, and these are going to be vehicles or accounts that donors use to fund their current giving to their favorite charities, like a private foundation, or what we do here at Fidelity Charitable, a donor advised fund. We'll take a look at those. That's for donors that want to fund their charities currently. Maybe they also volunteer there or something, so that's direct. The other category is making charitable gifts into some sort of trust that's going to generate income using charitable incentives, and then have, at the end of the trust period, whether it's the death of the grantor or at a 20-year range or something, then the trust corpus is going to get distributed out of the trust. We'll take a look at a couple of those, a remainder trust and charitable lead trust. This is where we go graphic, for those of you that are visual learners like myself. So the donor advised fund, that's what we do here at Fidelity Charitable. And a donor advised fund is an account or a program sponsored by a public charity, say Fidelity Charitable, or your community foundation. There's a Community Foundation for Northern Virginia. There's a DC Community Foundation. There's certainly a Richmond Community Foundation. There's 1,000 of them. And all of those, they're public charities that sponsor a donor advised fund. And you can see from the graphic how it works. An individual makes a tax deductible donation to the donor advised fund sponsor, the DAF. That's the immediate gift. It's fully tax deductible, whatever they give. And then the donor advised fund account will get invested for some period of time. And then the sponsoring organization will await the donor to advise what charities they would like us to support. So then the donor advised fund makes grants out to various charities. Just for perspective, here at Fidelity Charitable, on average, our donor advised fund account holders support about 10 different charities with grants out to multiple different charities. One of the advantages is, from a tax reporting standpoint, the gift to the donor advised fund, that's the charitable gift, and that's one receipt. And then if you support 2, 3, 4, 5, 10, 50 different charities out of the donor advised fund, you don't have to chase all of those receipts, because there's just one for the tax deductible donation to the DAF. So this is an appropriate vehicle for charitable people, which is, as we saw earlier, most people in America, for people that are charitable and want administrative simplicity around converting their appreciated securities into grantable form and then supporting multiple charities. It's quite straightforward. The minimum account size is very small. It's easy to operate, etc. So that's where we go with the donor advised fund, and it's quite a popular vehicle. The next vehicle you take a look at is the private foundation, and you'll notice that the graphic is identical, right? An individual makes a tax-deductible donation into the private foundation, which is for simplicity's sake, a private charity started generally by the donor themselves. They meet with their attorney and they create an entity, a private foundation, and it's going to be a 501c3 charity. And they're going to make a tax-deductible donation to the charity. And then the private foundation, as a general rule, is going to make grants out to multiple charities that do the charitable work that's important to the family that started the foundation. So graphically, it's pretty much the same. As we saw earlier, the tax deduction limits are a little bit lower for granting to a private foundation. And one of the reasons for that is because the private foundation has more generous provisions for what kind of charities they can grant to and what they can do on the granting out side. It's a little more flexible in the private foundation, but you also have, because it's a separate business, it's a standalone entity, the private foundation has some rules around it. You have to have a board of directors, they have to meet every year. There's a minimum distribution requirement of at least 5% every year. And there's a formal tax filing that has to be done every year for the private foundation. Sort of how much, what are the funds at the beginning of the year, at the end of the year, what charities did they grant to, did they pay any taxes, et cetera. Sort of a disclosure document for everything around the private foundation. So this is an appropriate vehicle for families that really want to get into the charitable business, that they want control, they want to have the control who's on the board of directors, what the charities are. One of the terms we talk about is if they want to read the scholarship applications, pick the kid that's going to get the scholarship, and then write the tuition check. For that, you'd want to be using a private foundation. The donor advised fund that we looked at earlier, the graphic is the same, but the donor advised fund is only going to make grants to other 501c3 public charities. So it's a little more limited outlook. So once again, for you that are in the planning business or planning customers, really what is it that you imagine your philanthropy to look like? And then you work backwards on what the appropriate vehicle is going to be. A couple of other ones, the Charitable Remainder Trust. This is a different entity, and you can see on the graphic a few more arrows. So the individual is going to make a contribution, but the contribution isn't going to the charity. The contribution goes into a trust. And in a Charitable Remainder Trust, what that means is that the donor, the grantor, is going to make a gift into the trust. And then the trust is going to produce income. The assets in the trust get reinvested to produce an income, and the income comes back to the grantor. And then at the end of the trust period or the death of the grantor, let's call it 20 years, then the income has come back to the grantor for 20 years, but the remainder interest goes out to the charities. So it's a way for a donor to convert property into income property, collect the income for 10, 15, 20 years, the period of the trust. And then ultimately, because there's a distribution to charity, there's some tax deduction at the gift into the trust at the front end. At the front end, the donor is going to take a tax deduction for the present value of the future gifts to the charities. Your financial planner will have some software, or your tax professionals will have some software to calculate that. It has to do with the distribution rate out of the trust, and it has to do with a 75-20 rate for discounting future gifts. And that's a moving target at the moment, but it's a way to, say, make a $1 million gift in your remainder trust, take a tax deduction for $500,000 now, and collect income for 10 or 20 years. And then ultimately the trust assets go to the charities. It's pretty straightforward. We see a lot of it. We see it with sort of land holders or something where you have a low income property that has a low basis, and you could put it in a remainder trust, convert the property in, take a tax deduction, convert the property into income producing assets. and use the air cover of the tax deduction to make that work. Opposite graphic, the charitable lead trust goes the other direction, where once again we have an individual that's going to make a contribution not to a charity but to a trust. And in this context, the income off the trust goes to the charity. So that's where the tax benefit lives. The income off the trust is going to the charity for the trust period of time. Maybe it's 10 years, maybe it's 20 years, or the life of the grantor. So you get the tax advantage of the trust making gifts to the charities. And then at the end of the trust period, maybe that's the death of the grantor, maybe that's, as I say, a 10 or a 20-year period, then the assets in the trust revert back to the family. So this is a strategy we see where a family may want to make a gift to the next generation or 2 generations down, and they use the lead trust format to transfer the asset out of the family's estate now and into trust, have the income stream go to charity for some period of time. That creates a great tax advantage and funds your favorite charities, but then ultimately the remainder, the asset reverts back to the family down a generation or 2, and any appreciation that's taken place during the trust period of time is transferred tax-free down to the next generation. So that's a great planning opportunity for families that are looking for both support their charities now and a generational transfer of assets. Once again, the tax deduction has to do with the expected income stream to the charity, the discounted remainder interest, etc. Your tax professionals and your financial planners will have some software to calculate that. So those are the main charitable vehicles that we see going on now. Here at Fidelity Charitable, we sponsor a donor advised fund program. And as we talked about in that graphic, we have another one where, the donor makes a tax deductible charitable contribution. They make the gift. It gets invested in for a period of time. The contributions have the opportunity to grow. Not so much this quarter, but over the years, Fidelity Charitable has given away $10 billion of investment earnings out to charities. So we make the gift, it grows, and then grants go out to IRS qualified public charities. Give, grow, grant. That's what we facilitate here at Fidelity Charitable. And let's take a look at where this might fit into a financial planning or a family's tax and charitable planning scenario. Let's talk about the tax code a little bit. You guys, people might remember at the end of 2017, Congress put into place the Tax Cuts and Jobs Act of 2017, was signed on or about the 23rd of December. So for taxpayers prior to the Tax Cuts and Jobs Act, roughly 37 million households itemized their taxes on their Schedule A, itemize their charitable deduction, itemize their taxes on Schedule A, because that was most advantageous for paying the least amount of taxes, right? So lots and lots of households, I submit that most of the people on the phone here itemized their tax deductions. Remember, we had the exemptions and then the standard and then all kinds of stuff. It was relatively complicated. What we got in 2017 was a simplification of the itemized deduction versus standard process, and raised the standard deduction for taxpayers up to roughly $11,000 or $12,000 each. So a married couple filing jointly, their standard deduction went up to roughly $24,000 or $25,000. And for many taxpayers, that mitigated the need to itemize. So in 2020, just a couple of years after Tax Cuts and Jobs Act passed, only 12 million or 60% fewer households itemized on their tax return. And what that means in practice, if you're not itemizing and you're using the standard deduction, then your charitable gifts are no longer having an impact on your taxes paid. You don't get the benefit of the charitable gifts if you're not itemizing. So let's take a look at a strategy that's become quite popular over the 4 years since the Tax Cuts and Jobs Act passed. Here's our sample taxpayer. There, we have a married couple under 65 who's in the 35% income tax brackets, whatever. And here's how their Schedule A looks. Their state and local taxes is part of the Tax Cuts and Jobs Act that was capped at a $10,000 deduction. No matter what your property taxes are, it's capped at $10,000. For discussion's sake, we give this taxpayer $500 a month of mortgage interest, so call that $6,000 of deductible mortgage interest on their Schedule A. And then to make it easy for us all to do the math in our heads, at Fidelity Charitable, we just have everybody give $10,000 a year to taxes or to charities. So in this context, that adds up to $26,000. For this year, the standard deduction for this married couple is $25,900. So this scenario, they beat the standard deduction by $100. So one way to think about this is their $10,000 charitable contribution above and beyond their other Schedule A entries results in a net $100 past the standard deduction, or a net savings on federal taxes of $35. That is not a satisfying tax savings for a $10,000 gift to charity for most people. The other thing we know at Fidelity Charitable is that most people, and you can think about yourselves, most people give the same amount of money to the same charities year after year. Speaking for myself, we make the same gift to the food bank. I send, hundreds of dollars to my alma mater, make the same gifts year after year. So if that is the case for our sample model taxpayer here, if they're going to give the same $10,000 each of the next 3 years, they're going to have a total tax savings of $100, right? $105. What if instead of that, instead of giving $10,000 a year for 3 years, they did $30,000 this year in 1 year? Now they're going to be, instead of being $100 over the standard deduction, they're $20,000 over the standard deduction. It's the same $30,000, but because it hits all on 1 year's Schedule A, it's $20,000 over the standard deduction. That creates a $7,000 immediate federal tax savings in this model client, for a net savings even over the 3 years of $6,900, right? So a considerable use in the tax planning for charitable is to pull forward several years of expected giving. And a use for the donor advised fund in this is you put the $30,000 in a donor advised fund this year and then gift it out at $10,000 a year to support your charities in their cash flow that they like, right? And then in 3 years, reload, take another big deduction, and then dole it out. That's a key thing. We see it all the time. Here at Fidelity Charitable, we'll probably open 15,000 new donor advised funds this year just for that strategy. The cohort for that, a companion for that strategy, is if a taxpayer happens to be having a particularly high income year. Maybe it's the year that you retire and you vest in your deferred compensation, or you happen to have been selling residential real estate in the first 2 quarters of this year, and you're having your best year ever. Or maybe you sell a piece of property, or you sell a business, or some such thing. So in 1 year, maybe this is your 1 year to be in the highest federal tax bracket. And then in later years, you might drift back down to the sort of more normal tax brackets, right? So this is a planning technique. If, once again, if you're going to make the same charitable gifts off into the future, it might make sense to pull those back and make one big contribution in the year in which you're in the highest tax bracket. And that creates a much better tax savings, not only over the year, but in the year when you're going to pay the most taxes. So we see this, once again, opportunity. This is where a donor advised fund sets in. In this example, put the $100,000 in the donor advised fund and then gift it out to support your charities over the ensuing decade. And maybe you get some investment earnings and you get an extra year or two of supporting your favorite charities. Only time will tell. The last one I wanted to touch on in the tax planning with equity markets backing up a little bit over the last couple of months, this might be time to revisit the concept of converting your IRA into a Roth IRA. Everybody would like to have their IRA to be a Roth because of the lack of RMDs, the tax-free transfers to children, the tax-free withdrawals. We all want it to be a Roth, but in order to do the conversion, it's a taxable event. You have to pay the federal taxes, right? So one thing to think about is, you know, if your account is a little smaller than it was at the beginning of the year because of the equity markets, it might be time to revisit. So in this example, we have a $500,000 IRA. If you convert it, it results in roughly $185,000 of federal taxes. If you're charitable and you're gonna be making $10,000 a year gifts anyway, this is a great time, as we saw on that high bracket slide, to make a $100,000 gift to charity now, pulling future gifts forward into this year, just in the year when you need your best deduction, and use your future charitable giving to offset the cost of an IRA Roth conversion here in 2022. That's a planning concept. Dan and his team can talk through that. Most people don't keep this kind of cash around, and so I want to touch on the reasons for using, as we talked about earlier, the reasons to use appreciated security or appreciated property to fund these charitable planning tools rather than cash. So here's our example. We have a top bracket taxpayer, a 35% bracket, and we'll make up a story that she has a call from her church. They've had some hail damage that time of year. They've had hail damage and they need $50,000 to fix the roof. So they call a key donor, and she looks at her portfolio and sees a $50,000 position that, for this example, happens to have a $20,000 basis and $30,000 of embedded capital gains. So she sees this position and she says, sure, I'll send you the $50,000. But left to their own devices, what most people will do is convert this appreciated property into what we like to think of as grantable form. She'll sell the stock, turn it into cash so she can write a check to the charity. What actually happens then is, because she converts to cash because she sold the stock, that in this example creates a $7,100 capital gains tax bill. So she has to pay those taxes. So really her net donation to the charity isn't the $50,000, it's $42,000. And she'll take that as a tax deduction and saves about not quite $16,000 in federal taxes. There's nothing wrong with that. The charity has better than $40,000. She takes a $15,000 tax deduction for the cash gift to the charity. It's great. But over here on the other column, with a little creative thinking and some financial planning, if she sends the securities directly to the charity will sell them because they need cash to pay the roofer. The charity will sell them, but they're going to pay no capital gains taxes on this transaction because they're a charity. So now the net charitable gift is the value of the securities when they transferred them. That's the full $50,000. So the charity has the $7,000 that doesn't get paid in capital gains taxes, and the donor takes the tax deduction for the full value of the securities given, $18,500. So the charity, the donor saves $3,000 in taxes, give or take, and the charity has $7,000 more. So the gift of appreciated securities is a significantly better improvement. And when we look at those techniques we looked at earlier of maybe funding 2 or 3 or 4 years of future charitable giving to maximize your tax benefit, to really maximize that is you use appreciated securities to fund those larger gifts and transfer the embedded gains to the charities so the taxes don't get paid. So this is a great technique. It's the kind of thing we work on with financial advisors all over the country. Let's talk about some other assets that might make sense for gifts, what we call complex assets. And these are properties owned by investors or business owners that aren't immediately liquidatable in public markets. Private securities. What we see mostly at Fidelity Charitable is private company stock. You know, if you own a widget factory, You don't really own the widget factory. You really own the shares in Widget Factory Incorporated, right? S Corp shares, C Corp shares. Maybe it's put together as an LLC with multiple partners. So those, what we call complex assets, other things in this category, Bitcoin, cryptocurrencies. If you're an employee of a publicly traded company and you're far enough up the food chain that you have restrictions on liquidity around your stock, that kind of thing, these are all what we would call complex assets. And they're giftable under the same rules, but there might be some legal controls about can you give them and how do you sell them and all of that. So we refer to those as complex assets because they're not simple gifts. And here at Fidelity Charitable, we have a team of attorneys to work with donors and donors advisors around this kind of gift. Last year, we saw a lot of Bitcoin gifts, as you might guess. Several $100 million of cryptocurrency came into Fidelity Charitable to donor advised funds. This year, I believe we're at 0 gifts of cryptocurrencies. Maybe you've been reading about it. But mostly what we see is private company stock. If a business is, if they're having a sale or some sort of recapitalization transaction, there's an opportunity to make a gift of highly appreciated shares to the public charity, and then the charity will sell the shares to whoever the buyer is for the business. That's what we see mostly. So let me put my legal hat on and talk a little bit about gifts of these sort of complex assets and the key points that the charity is concerned with around that. The first one we think about, and let's use it as a business owner, you know, you and your brother-in-law own a business and you're going to sell the business and you want to make a gift of shares to the charity. The main thing that we're going to be concerned with at the beginning is, are the shares in fact transferable? Can this gift be made? Is there something in the legal documents or the corporate documents or shareholders agreement that limits transferability? Maybe there's a right of first refusal. Maybe there's a restrictions on non-employee shareholders. Maybe there's a restrictive buy-sell agreement. Something that might limit the transferability from the current shareholder out to the charity. And if that's the case, in many times the shareholder agreement can be amended quickly to allow for the charitable transfer, but the first consideration is, can the gift get made? And then once again, speaking for the charity down here in the lower left-hand corner, is the charity doesn't really want to be a business partner for very long. So the charity is going to be concerned with liquidity. If you give us these shares in your business, how are we going to get rid of them? What is the path to liquidity? So we see these kinds of gifts mostly in the transaction of some sort of sale or spin-off or recapitalization of the business that would give the charity the opportunity to liquidate the gift and get out of the business and put the funds available for granting to charity. So we want to talk about a path to liquidity. And then the key thing also is around the timing of this. In order for the tax deduction to work, the gift has to be made before the donor sells the business. So the gift has to be made before the final selling agreement is inked. And then the charity sells the shares. It's just the same in the public securities business. If you give us Apple shares from your brokerage account, we'll take the Apple shares, we become the owner of the Apple shares, and then we immediately sell them and reinvest the proceeds in your donor advised fund, right? If you give us shares in your business, we're going to be immediately looking for a place to get rid of them, but we have to take full possession of the shares in advance, unencumbered. So the gift has to be done before the final deal is inked. There's some finesse around the timing. Here at Fidelity Charitable, we are perfectly comfortable with this kind of gift after a non-binding letter of intent is signed. So there is, in fact, a clear path to liquidity, but before the binding final sale agreement is signed. So in that period of time, that's when we see these gifts. Some valuation. We need to know what's being given to us and what it's worth. If the company's had some recent valuation work done, that's great. Recent K1s, 409A, Maybe if there is a letter of intent, then we know the value of what we're being given, which is great because we have to carry it on our books for some brief period of time. The second thing around valuation is in order to take the tax deduction for a gift of private securities to us as a charity, the taxpayer, the donor, will need to obtain a third-party appraised valuation of the gift that has to be attached to their tax return to validate the deduction. So the donor has to obtain that outside. I suspect PBMares has a valuation team that can help you with that. And then from a risk management standpoint, speaking for the charity, we need to be carved out of various risk parts of a sale, reps and warranties, all sorts of things that statements that the seller might be making, but the charity needs to be carved out of that. We have model language to work with attorneys to make that happen. So it's never a big deal, but we want to make sure that, Fidelity isn't taking on some sort of risk associated with the history of the business that we can have no way of mitigating. So we work on that. So let's take a look at this private business interests. We'll skip ahead to the next slide. So here's our donor. We're coming down to our last few minutes on this. Here's our business owner donor. Jane is going to sell her company for $10 million. She is very philanthropic. So she's thinking about how to make the best gift, how to get the best leverage for supporting her favorite charities using the wealth that she's created in her business, right? So she has three main options. The standard course of events, and Jane is particularly generous, so she's going to make a 20% gift. And it makes sense for the math on the next slide. But so the normal course of events is she meets with a buyer, they reach an agreement, she talks to her tax and legal team, she tells them she wants to do something charitable, and they say, look, let's just get this deal done, and then we'll make a gift after the smoke clears, and then we'll do this charity thing. So the 20% of after-tax proceeds option is one way to go. The second one, maybe her alma mater has, or her other charities have a planned giving department, and they talk about an annual giving strategy where you plunk in a big gift in the first year, 10%, and then subsequent annual gifts. And then the third one, which is what we're talking about today, the option of making a gift of 20% equity in the business in advance. We talked about these other considerations of timing and can the gift get made, et cetera. Let's go to the spreadsheet, right? So here's our three choices. Option one, the donor is going to do a 20% gift, but she's going to do it after the deal is closed. So in her head, she's doing a 20% gift. She's thinking about a $2 million gift, but because she's going to do it after the deal is inked and closed, 20% of the after-tax proceeds of the business, after capital gains tax are paid, the 20% is not $2 million, it's $1.5 million, because she's paid $2.5 million of capital gains taxes. So her 20% of $7.5 million is $1.5 million. So she's going to make $1.5 million gift to her favorite charity. Let's call it the hospital. She's going to take $1.5 million tax deduction because it's cash, and she has a high AGI this year because she just sold business. Total tax paid is about $1.8 million in all capital gains. And in the end, after the charitable gift, which is super generous, net into her brokerage account is $6.6 million. Nothing wrong with that. It's great. The charity has $1.5 million. They put her name on the bench. It's great. Let's take a look at option two. This one, she's writing nominal checks, even though it's after tax, but she's going to write a check for $1 million in the first year and then $100,000 a year for the next decade. You can see we've done the tax bracket thing. She's got her one big year where the transaction takes place. That puts her in the top bracket for maximum discounting, maximum deduction. But then in later years, working with her financial advisor, she's going to be in a lower bracket. So the later gifts lose a little bit of tax leverage. You come down to the bottom. She has given $2 million to the charity. She has taken $2 million of charitable deductions. She has paid a little bit less in taxes, but a lot of it is hit in lower brackets. So not including for growth, net into her account is about $6.2 million. And she has an endowed chair at her alma mater, which is great. Optimal though, every conversation with a business owner who might have a liquidity event should take a look at this. Let's say she gives 20% of equity in the business to the charity in advance of the deal. Now there's a couple of things at work. Her taxable event is not the $10 million that she's selling the business for, because she took us in as a minority partner. Her taxable event is only $8 million, and she has a $2 million tax deduction. You come down to the bottom column. Now the gift to the charity is the $2 million of the equity gift. That's the tax deduction. Her taxable event was $2 million less, right? So her net taxes paid is not 1.8 or 1.7, but $1.1 million that she's out of pocket on taxes. So the charity has $2 million, and net to her account is $6.8 million. So because of the lower tax event, she ends up with a few dollars more in her account, and the charity ends up with $500,000 more in their account. So it's a great technique for business owners that are approaching a liquidity event, if they are charitable, to take a look at this as maybe an opportunity to maximize their giving. There's a couple of quick considerations on this. One of the challenges that we talk about is gifts of private securities to public charity. You're going to take a tax deduction for the fair market value as appraised, as we looked at earlier. If you gift it to a private charity, as a general rule, your tax deduction is going to be your cost basis in those shares. And for a lot of family businesses or privately held businesses, the difference between fair market value and cost basis can be dramatic. So there's a key conversation there around the tax benefits. And then there's sort of the other stuff that we talked about. But I think I'm coming to the end of my time here. So here at Fidelity Charitable, we work closely with donors and donors advice ecosystem, like our partners at PBMares. And we have all kinds of resources to support people in their charitable planning stuff. We do have a team of in-field experts like myself who call on donors and financial advisors. We do, in the complex asset space, we do have our own team of attorneys to work with donors to facilitate the more complicated gifts. All kinds of resources, and a great team on the service side to help our generous donors get the funds out to their favorite charities in a timely manner. And with that, I'm going to hand it back to Dan to run some Q&A.
Awesome. Thanks, Jim. Thanks so much for sharing your experience, your expertise with us. And I know it's particularly rewarding for me and the rest of the PBMares team when we get to sit down with our clients to figure out how to use these advanced giving strategies, especially in the context of all kinds of financial goals and tax planning. And because every situation is different, it's always worth a conversation just to see how all the pieces kind of fit together. We did have a couple questions come in. One of them off the top, can you make a qualified charitable distribution or QCD into a donor advised fund?
Yeah, that's a great question. And we get it all the time because particularly donors over age 72 that want to support their charities, they have the opportunity to move money out of their IRA directly to charities, right? They can use their required minimum distributions or what the QCD, the qualified charitable distribution, to send funds straight to the charity and bypass their personal tax return, which is a great technique. And unfortunately, from an administrative standpoint, as good as it would be to make those, to use a donor advised fund in between, the code currently specifically denies using or excludes donor advised funds and our type of public charity from the QCD. Please talk to your congressman.
Great. A couple other questions. Can I gift real estate to a DAF?
That's great. Yeah, you know, just like all of those other sort of things that we looked at, real estate gifts, you can in fact gift like any other appreciated property to a donor advised fund, and then the donor advised fund will seek liquidity, like in this context, sell the property and put the funds into the donor advised fund, thus converting the real estate into grantable form to support your charities. You can do that. It works pretty well. There's a couple of things to think about around that. For investors that own property, chances are they think that they own the property, but they really own is the LLC units or the LP units in the partnership that owns the property, right? And so as we saw before, the LLC shares can easily be gifted to the charity, and then the managing member of the LLC then proceeds to sell the underlying properties, and the sales proceeds from selling the property distribute out to the various members of the LLC, which then would include the charity. That's the simplest way to do it. And it works because that gives the donor the ability to make fractional gifts of real estate to the charity. For real estate in which you hold the deed, it's quite difficult to split the deed up and give pieces to the charity. Speaking specifically for Fidelity Charitable, we would not be interested in the joint and several liability concept of a split deed. And so you'd have to give us the entire piece of property. And once again, speaking for Fidelity Charitable, we would only take in a piece of real estate under some specific circumstances, pretty high value, no debt, no tenants, because we would be becoming the owner of the property, and we don't really want to be landlords. It's not part of our charitable mission. But there are some charities that we know of that would be happy to work on a direct real estate gift like that, and be happy to work on that. And then ultimately we would end up with the funds once again back in a Fidelity Charitable donor advised fund. So there's a path for making real estate gifts. Some are more complicated than others, and but see your PBMares planning specialist and we can work through it.
Great, thanks for that. And one more question from one of the attendees. I am thinking about selling my business and gifting shares. When should I plan to make a gift?
So you should, if you're thinking about selling the business, so you should be engaging with your legal and tax advisors sort of early on to sort of start sketching out what that's going to look like. And as you get closer, making the gift to the charity, you would want to engage with your advice team about making the gift. There's no time that's too early for that, but you'll want to make the gift and have the charity become a minority shareholder in the business before you ink the sales deal. It's a little bit of an optics question, and it takes us a few days to take possession of the shares. So call it a week before you sign off on the final deal is generally when we get most of those kind of gifts, in the last couple of weeks of the due diligence period.
Awesome. Thank you, Jim. And thank you for all the attendees for joining us today. We hope you found this presentation helpful and informative. If you sent in a question and we didn't get to answer it today, one of our team members are going to follow up with you, or you can feel free to reach out to us for a more detailed discussion. As we close today's webinar, you're going to receive a brief 3-question survey. Please take just a minute to complete it. Your responses really help us to develop future webinars and content. And thank you again, and have a great afternoon.